Good evening. This is Mike Bertelson, the Bear Market Investor, with a market update for January 2nd, 2011. We are looking at the weekly time frame of the volatility index. This is a very, very important index to track. A lot of people, unfortunately, feel that it's irrelevant. I do not. I think it's extremely relevant to what the market has in store for us here, in the near future, as well as in the intermediate term. Let's go ahead and jump right into this. As we can see, we have two areas of support here. We have a longer term area of ascending support. We have a horizontal area of support here back from the April 2010 peak in the market. We saw that surge there. The surge allowed us to form this longer term area of resistance here in the market. And I've also done some work with the Fibonacci Fan. Not a lot of people understand this tool. I'm going to show you just how it works here on the volatility index. Let's go ahead and jump in on the daily time frame. Now, as you can see, with the volatility index and this Fibonacci Fan, this has worked out perfect. Take a look at how this forms. All I did basically was draw this. This was the initial rise or falling wedge that we had broken out in August, and we saw that surge in volatility there coming to the 38.2% retracement on the Fibonacci Fan, falling further yet before breaking out of that, coming back down and back testing the underside of that, also forming the lower area of declining support here in this overall falling wedge pattern that we're working in. We then saw a thrust to the upper boundary of the 61.8% Fibonacci retracement on the Fibonacci Fan before coming back down, briefly breaking through the ascending area of support, finding support at the horizontal level before closing back above this ascending area of support. Now look at where we are here. We are essentially in a wedge form here that is likely about to break out. This is why I happen to feel that probably within the first week here of trading in January, we're going to see a surge in volatility. This is likely going to correspond with a larger correction in the markets than we had, just previously here. So I do think that that correction is likely to be larger than that which we saw in November. It's likely going to be somewhere in between where we sold off to starting in April and where we are now. We'll just have to wait and see. Or we could get something similar to this, where it kind of waffles sideways, hits this area of resistance here, which is at the 78.6% retracement, as well as that declining area of long-term declining area of resistance that we have in the larger picture here. So, this is very fascinating because that long term happens to coincide exactly with a 78.6% retracement on the Fibonacci Fan. Now, as you can see, part of my prediction that I had in the market with regard to why we may actually hold up longer, and that this may not inevitably be the final top in the market, is based on the VIX. Now, this doesn't necessarily tell us that that's going to be the case. It just could tell us that we may not see the massive sell-off we're expecting until later in 2011, perhaps June or July. But certainly, I'm expecting that to become increasingly likely as we come into April. So again, I'm expecting a sell-off to begin occurring very, very soon. Now, if this were to break this area of resistance, I'm going to become very, very bearish on the market very quickly, unless we find resistance at higher levels, perhaps another area of horizontal resistance or something like that, and then we end up having a longer term area of resistance that forms in the market in the form of a larger wedge pattern. But again, this is just something that the market has to tell us over time, but I am going to become very, very bearish on the market as soon as we break this area of resistance, at the 78.6%, as well as this long-term descending line here. So let's go ahead and watch to see what happens. But I do think that this certainly fits with the possibility that we rally, we correct, and then rally into April, May, June, or perhaps even July before the serious volatility enters in the market and the long-term sell-off ensues. Now, I briefly brought up the American Association of Individual Investors. This is a organization that basically does a sentiment survey every single week, and they publish results. And what we can see here, using this as a contrary indicator, is that the market is really ripe for a reversal. These types of readings are extremely few and far between where we're getting this type of bullishness in the market, and almost not a bear to be found. I mean, we can even scroll back down and you see nothing else that resembles the type of bullishness that we're getting here at this point in time. This reading was as of December 23rd. December 30th, it had come down a little bit. The bearish camp started to fill up just a little bit more, but certainly not anywhere near where it should be for really a healthy market that has no change in direction that is forthcoming. So, this is the type of thing that we see accompany tops in markets, and vice versa, where if we saw everybody was sitting in the bearish camp and the market had been declining for a sustained period of time, we would likely want to start looking for a point of reversal at that time where we saw everybody sitting over here in the bearish camp and very few people in the bullish camp. But this is historically significant in that we haven't seen this type of reading for many, many years. So in any case, something to pay attention to. I do believe that after you see this decline slightly here as of December 30th, that it is likely that we'll start seeing the correction begin very, very soon. I generally tend to look at this much like I look at the CBOE put to call ratio and things of that nature, where usually you see the moving average change direction after it had reached an extreme, and then you see the correction take place. So it's just a matter of using it as a contrarian indicator. It doesn't necessarily signal that something will happen. It just suggests that in context with other readings that suggest the same thing, that we are likely to see a correction at the very least transpire here very, very soon. Now, real quick before I go ahead and end the video, I want to show you the Investors Intelligence data here compiled by Market Harmonics. I just pulled up their website quickly. Now, as we can see, historically we are at a low point for the percentage of bears here. We're not quite as low as we were back here, but we are pretty low. We're certainly as low as we were in 2007. Now, let's go ahead and take a look here at the percentage of bulls. This is actually very, very telling here. You can see we put in a fresh new peak here for this rally off of the March 2009 lows, challenging that 2007 peak for the percentage of bulls. This is very, very bearish. That means that the majority of people at this point, the vast majority, believe that this is a one-sided trade, that there is no downside risk. they are willing to pay large premiums for the privilege of riding the market up. That is also potentially going to cause some panic selling should the market actually reverse, because people are so bullish and they're paying so much for the privilege of riding this market up and making money at that as well. So let's go ahead and scroll down here to the bull-bear spread. This is another thing that you can see here. We're putting in some real peaks here at this point, challenging that 2007 all-time peak in the stock market. This is the type of thing we expect when we see large sell-offs that are about to occur. Now, going all the way back to the April 2010 peak, you can see that we had put in a peak there, and then we had a pretty substantial decline in the spread, and that accompanied the decline in the stock market as well. Just recently we did not see that change too much here with the most recent sell-off, so I do believe that we're likely to see the market actually have a fairly substantial correction. May not be as much as we had really in terms of the sell-off in April, in that we could actually hold up a little bit longer, perhaps into the middle of the year as far as the stock market is concerned. But I do believe that the spread is in fact putting in a top here at this point. Let's go ahead and wait and see what happens, but do be on guard if you are in fact long the market at the moment.